What happens if the stock market crashes right after you retire? It's one of the biggest fears retirees face, and for good reason. A major downturn at the wrong time has the potential to derail your retirement. I'm Nick Hearne, financial advisor and portfolio manager at RGF Integrated Wealth Management. And in this video, I'll walk you through practical strategies to protect your retirement from a market crash so you can retire with more confidence. There's no strict definition of a stock market crash, but when markets fall 20% or more, that's considered a bear market. And here's the reality. Over the past 80 years, bear markets have happened roughly every 5 years. So if you're retired for 20 or 30 years, you're almost guaranteed to experience multiple downturns. That can sound alarming, but the key is being prepared, not just reacting once it happens. When you're still saving, and you're more than 5 years away from retirement, the best move is usually pretty simple. Stay invested and ignore the noise. In fact, downturns can be an opportunity. If you have extra cash to invest, you're effectively buying stocks on sale, and future recoveries work in your favor. But in retirement, things get trickier because you're now withdrawing money instead of saving it. And that brings us to one of the biggest risks retirees face, sequence of returns risk. This is a timing risk. When you introduce withdrawals from a portfolio, the investment returns that occur in the earlier years matter more than those that occur in the later years. Let's say two retirees start with the same portfolio and withdraw the same amount of money each year. The only difference? One of them retires right before a market crash, while the other retires during a bull market. Even though they both earn the same average return over 25 years, the retiree who suffered early losses runs out of money much sooner. That's the danger of sequence of returns risk. You can't predict when a downturn will happen, but you can prepare for it. Here are 3 strategies. First, establish a solid base income. Your base income is made up of reliable income sources unrelated to your investments, such as pensions, CPP, and OAS. Your investment risk will be lower if your base income is sufficient to cover your essential needs. Life annuities and delaying government benefits are some of the options for increasing your base income. Secondly, use an income ladder in early retirement. Holding 2 or 3 years worth of expenses in cash or term deposits can help you ride out market downturns. And third, use a dynamic withdrawal strategy. Structure your spending to maintain flexibility and limit future obligations. This will allow you to decrease your spending during down markets. If a crash hits and you don't have a plan, stay calm and remember, markets go down. It's a normal part of investing, and historically, markets have always recovered. Review your spending and cut or defer discretionary items if you need to reduce your withdrawals, and be strategic about withdrawals. If you're able to withdraw from cash or fixed income, this will give your equities time to recover. And most importantly, avoid panic selling. Emotional decisions can do more damage than the decline itself. Market crashes are inevitable, and they can be stressful. But with preparation, flexibility, and perspective, they don't have to derail your retirement. Thanks for watching. If you found this video helpful, please consider liking and subscribing for more tips on retirement planning.